Here's a topic that's come up several times during the course of my meetings this week, and I thought I would cover it here on the video. I've talked about this in the radio. I figured it would be bear some repeating here on video and in video form. The concept is this. A lot of people talk about, their experience of investing over the last 10 years being very bad, bad returns. And, I've talked about how various areas of the market over the past 10 years are up 250, 350%. Investors shouldn't have fared poorly over the past 10 years. But here's the underlying fear when it comes to investing. The risk that I could lose all of my money. And, you hear people talk about that. Well, stock market, I'm worried about losing all of my money. And I thought I'd talk about that for a second, because if you think about it, where are the stories coming from of people losing all of their money? Well, there's one scenario that we see where people can and often will lose all of their money, and that is in individual stock selection. Maybe they choose a particular company. They invest a lot of money in a particular company. Maybe it's their stock plan at work. Maybe they own stock in the company that they actually work for. Global Crossing, Enron comes to mind. A lot of people did that. They invested in those companies, and the companies went out. They went bankrupt. They disappeared. Or companies like Kmart. Kmart's still around, but it's a company that actually is a different company than what it was before. Their ticker is different. Anybody that owned their stock previously got a big goose egg when they went down, and now it's a new stock. There's a new company involved in it. Another scenario, though, comes from the Depression. You think about the older people, maybe grandparents or parents that actually lived through the Depression, or people that talk about people losing everything. What happened during those years, for a lot of people, was this. Let's say that you had somebody that had a couple $1,000s, and they said, you know what, I'm hearing about all my friends. They're just getting rich. They're making so much money in the stock market, the roaring 20s. Everything was going great. The market just kept going up and up and up, and they thought, wow, you know what, how can I get in on this? I want to get in this gravy train. And what they would do is they'd go to a brokerage firm, and the brokerage firm, yeah, you know what, you could double your money. You could take this $2,000 and we could double it. We could make it $4,000. So we could make you a lot of money. But here, we got even a better idea for you. And here it is. We're going to take your $2,000, and what we're going to do is we're going to lend you $8,000. So now you can invest $10,000. And you can take that $10,000, and what we'll do is we'll double that. We do some good investing for you and your account, and we can make that into $20,000. And you pay us back the money. You pay us back the money you borrowed, the $8,000, and you got $12,000. So basically, you turned $2,000 into $12,000. Sounds good, and a lot of people bid. A lot of people did it. The only problem was the market didn't go that direction. It went the other direction. So their $10,000 became more like $4,000 when they invested, and in some cases even worse. And then what happened is, now that their account was $4,000, the brokerage firm came back in and says, hey, that $8,000 that you borrowed from us, we need that back. So what ended up happening is, now my $4,000, I sell all of the stock at the market low, and then I pay the $8,000 back, and I'm in the hole $4,000. So people had to sell cars, they had to sell houses, they had to sell their possessions in order to pay back what they actually owed, and all of a sudden they were broke. But if an investor had followed just some prudent rules, not borrowing on leverage, they would have been just fine even during the Great Depression. So there's a little rule of thumb here. Don't follow the leverage rules, don't do those types of things. Make sure you invest prudently, you diversify, but don't worry about losing everything. Because what has to happen for me to lose everything in the stock market? Well, if I'm well diversified across dozens of companies, which is what we always talk about here, and thousands of stocks, all of those companies would have to simultaneously go bankrupt with no residual value. And think about it. Companies own buildings, they own land, machinery, and equipment. All of that stuff would have to be worthless for that to actually come about. Not a real likely scenario. Hope that helps, and maybe send this to somebody that's scared of the stock market and doesn't understand the stock market, and some of our other videos. And if you got comments, you got questions, send them to me. I'd love to hear them. Thanks.